Okay, let's dive into one of the oldest, most debated questions in all of investing. It's a true head-to-head battle between two completely different philosophies. Today, we're going to settle the score with a data-driven duel, dollar cost averaging versus lump sum investing. So, let's make this real for you. Imagine you've got 10 grand sitting there ready to invest. What's the move? Do you go all in right now, or do you play it a little safer and kind of ease into the market over the next few months? This one decision can make a huge difference in your returns.
All right, so in one corner, we have lump sum investing. That's putting all your cash to work at once. And in the other corner, we've got dollar cost averaging, or DCA, where you invest a set amount on a regular schedule. We're going to break down both of these using some fantastic research from our friends at fffinstill. This slide, right here, it perfectly nails the core trade-off. See, with a lump sum, you get maximum time in the market from day one, which is awesome if the market goes up. But you also take on all the risk of just having terrible timing. DCA, on the other hand, well, it's just easier on the nerves, right? It feels safer because you're spreading out that risk. But which one actually wins more often? Let's get into the numbers.
Okay, let's ring the bell for round one. First up, we're looking at the average scenario. You know, the most common market environment. And in this fight, one strategy has a pretty clear advantage historically.
And there's the number. Almost 2/3 of the time, looking at a 5-year window, putting all your money in at once has flat out performed better. And the reason is simple. Time in the market is what really counts.
And this data here really drives that point home. Just look at the average return for lump sum. It's a full 15 percentage points higher than DCA. So why such a big gap? Well, it's pretty simple. Markets tend to go up over time. So having all your money working for you from the very beginning just captures more of that growth.
But hold on, the fight is not over. Not by a long shot. See, averages can hide the extremes, and in investing, it's those extremes that keep us all up at night. So let's move to round two and see what happens when things get scary. This is DCA's moment to shine.
This is the question that haunts every single investor, isn't it? What if? What if you put your money in the day before a huge market crash? Well, this is where the story takes a really dramatic turn.
Just look at that. Almost 80%. That is DCA's win rate when you start your investment right before a bear market. This is so important. When you need that protection the most, DCA is the strategy that actually shows up, and it can turn a potential disaster into a massive opportunity.
I mean, these numbers tell such a powerful story. If you'd invested right before the 2022 bear market, the DCA strategy didn't just win, it absolutely crushed it. We're talking an average return that was a staggering 50 percentage points higher. So how does that happen? Well, by spreading out your buys, you automatically buy more and more shares as prices are falling. This just hammers down your average cost and supercharges your returns when the market finally turns around.
And here's the perfect case study. If you had invested in JP Morgan right before that downturn, the lump sum investor still did okay, made about 58%. But the DCA investor, the one who kept buying all the way down and then back up, they nearly doubled their money. That difference is just absolutely insane.
So we've seen both strategies have their big moments. But you know, this whole debate kind of assumes you have a big pile of cash just sitting around. For most of us, that's just not how life works. We invest bit by bit, from our paychecks. And you know what? That changes the whole game. See, for the average person, DCA isn't really a choice. It's just how investing works. And the power of this consistent, steady approach is mind-blowing. At a 10% annual return, just investing $500 a month for 20 years turns 120 grand of your own money into over $360,000. Think about that for a second. 2/3 of your final balance isn't money you put in. It's pure, unadulterated growth.
But what happens if you just stick with that same plan for one more decade? Well, that's when the real magic happens. 30 years of consistent, automated investing turns that $500 a month into over $1 million. Let that sink in. That last decade adds more than $600,000 to your balance. That is the incredible exponential power of compounding at work.
So what's the real takeaway from all this? The real champion isn't lump sum, and it's not DCA. It's consistency. It's the simple, almost boring act of just investing regularly over a long, long time. That is what builds true wealth. Honestly, this whole debate matters so much less than the decision to just get started.
So, how do you take all this and apply it to your own life? Well, let's go to the judge's scorecard for a clear, simple framework to help you figure out which path is the right one for you.
You might want to go with lump sum if you've got a long time horizon. We're talking 5 years or more, and you've got the stomach for it. You can watch your portfolio dip without freaking out and selling. If that money's just sitting in cash anyway, history says putting it to work sooner is usually the winning bet.
Now, on the flip side, you should probably lean towards DCA if the markets feel a little pricey and you're worried a correction might be coming. But more importantly, if the thought of a big, immediate loss would make you panic sell, then the psychological comfort you get from DCA has real, tangible value. You know, this whole data-driven breakdown is based on some really incredible research from FinStill. If you want to dive even deeper into this stuff or check out over 300 other free learning concepts, you should absolutely follow them and visit their site. They do an amazing job of making really complex financial ideas super clear.
So, at the end of the day, after all the numbers and all the debate, this is where we land. We can analyze strategies forever, but the single most important variable in your financial future isn't the method you pick. It's the moment you finally decide to begin.